Hi everyone. In this lecture video, we will going to have the introduction to sensitivity analysis. Sensitivity analysis will be used if the sales price as well as the variable cost rate, the total fixed cost, and sales mix ratio will change. In this lecture video, we will going to demonstrate what will going to happen, what will be the changes, what will be the effect if one of the variable going to be changed. The process of considering the impact of these changes to profit. Profit will be our determinant at the end of the day because that will be the bottom line of your income statement. And what is the relationship outcome? That will be called the CVP sensitivity analysis. So the sensitivity analysis will not only affect the changes in profit determined, but also it will going to affect the contribution margin, the margin of safety, the break-even point, and the operating leverage. For the margin of safety and operating leverage, we will going to have a thorough discussion on a separate video. Now let's have ABC company as our illustrative example. The unit sales price is 80, then the total fixed cost is 600,000. The budgeted sales in terms of units is 45,000 and the tax rate is already provided, which is 30%. Now that we have here the unit contribution margin, we can be able to derive the unit variable cost, and that will be 50 pesos. Now let's compute for the following scenarios. We have scenario A to scenario E. Let's compute for the operating profit. The operating profit here is the contribution margin, which is 45,000 units multiplied by unit contribution margin of 30. That will give us 1,350,000. And the total fixed cost is 600,000. Therefore, our operating profit is 750,000 pesos. Then let's try to compute for the break-even point in terms of peso. That will be 600,000 divided by 37.5%. So how did we compute for the 37.5%? That is 30 divided by 80, 37.5%. That is our unit contribution margin ratio. For the BEP in terms of peso, that will give us 1.6 million peso. So this will serve as our benchmark or base amount. Any changes from letters A to letter E, we will going to compare it to our base operating profit and to our base BEP in terms of amount. Now let's try to solve for letter A. For letter A, remember that the unit sales price will going to increase by 20%. So if the unit sales price will going to increase by 20%, number of units here that is 80 multiplied by 1.2, that will give us 96. Since the unit sales price will going to increase, the unit variable cost will remain constant. That will be 50. 96 minus 50, our unit contribution margin here is 46. So our contribution margin ratio here is 46 divided by 96. That will give us 47.92%. The total fixed cost will going to remain the same. So that will be BEP in terms of amount. That is 600,000 divided by 47.92%. That will give us 1,252,086 pesos. 45,000 units multiplied by 46 unit contribution margin, that will give us 2,070,000 less our fixed expense of 600,000, that will give us 1,470,000. If you're going to notice, if there will be a change, if there will be an increase by 20% in the unit sales price, the operating profit will now increase from 750,000. It will now be 1,470,000. That is before tax. Now, in terms of break-even point, before the increase in the unit sales price, you will go in to sell 1,600,000 in terms of amounts. But in this case, you will only be needing to sell 1,252,086 pesos. Meaning to say that you will going to sell less in terms of amounts for you to meet or for you to reach the break-even point in terms of pesos. Now let's try to work out with scenario B. The unit variable cost will going to increase by 10%. So our unit sales price is 80. The variable cost is supposedly it's 50, but it will increase by 10%. So multiplied by 110%, and our new unit variable cost is 55. Then let's copy here the 80. Our unit contribution margin is 25. The number of units sold is 45,000 multiplied by 25. You will going to have a sales of 1,125,000. Then your operating profit will now be 525,000. Then let's compute for your contribution margin ratio. That will be 25 divided by 80. You will going to get 31.25%. And this 31.25%, let's use this to compute for the break-even point, and that will be 1,920,000 pesos. Meaning to say that you have to have a bigger sales in terms of amounts compared to the previous one. You only need to have a sales of 1,600,000 to reach the break-even point. But now in the scenario B, you need to have 1,920,000 to reach the break-even point. Because of the increase in the unit variable cost, your operating profit will go down from our baseline of 750. Now it's only 525,000. Now let's compute for scenario C. The total fixed cost will going to decrease to 450,000. So meaning to say, it's not yet anymore 600,000, but rather it is now 450,000. So everything else will be equal. So this is 50. Your contribution margin rate is 30 divided by 80. You will going to get 37.5%. And in terms of the operating profit, 45,000 multiplied by 30, you will going to have 1,350,000 less 450,000. That will give you 900,000 operating profit before tax. Then 450 divided by 37.5%, that will give us 1,200,000. Meaning to say that if there will be a cut to the total fixed cost from 600,000 down to 450,000, the required sales for you to reach the break-even point is now only 1.2 million instead of 1.6 million. And your operating profit will increase from 750,000 here for our base amount. It will now be 900,000 pesos. Let's compute for scenario D. the units sold increased by 20%. So meaning to say, the 45,000 here will be multiplied to 120%. And that will be 54,000 units. So everything will be equal. So let's put a 50 here. It's 37.5%. Then our total contribution margin is 54,000 units multiplied by 30. That will give us 1,620,000. Then our operating profit before tax is 1,020,000. Then our break-even point is 600,000 divided by 37.5%. That will give us 1.6 million pesos, which is exactly the same as to our base amount. So meaning to say that if there will be a change in the number of units sold, the break-even point in terms of amount will not going to be affected. But the operating profit before tax will now be 1,020,000 instead of 750. So it will going to increase because you will going to sell more. Then you will incur more operating profit. Then let's compute for scenario E, the last one. The unit sales price will increase to 100 pesos. So before we have 80, now we will go into write it here 100 peso. There will be a 20 pesos increase. Next, the unit variable cost increased by 15%. So the 50 pesos will now be multiplied to 15%. 115% rather. So 50 multiplied by 115, that will give us 57.5. Then we can now be able to compute for the unit contribution margin. 100 less 57.5, that will give us 42.5 divided by 100. So that will be 42.5%. 42.5 peso multiply to 45,000 units sold, that will give us 1,912,500 for our total contribution margin less 600,000. Then the total fixed cost will going to increase by 5%. So instead of using 600,000, we will going to multiply it by 1.05. So our new total fixed cost is 630,000. To compute for the operating profit, that will be 1,912,500 less 630,000. Answer operating profit 1,282,500. Our base operating profit is 750. Now it will going to increase to 1,282,500. Now let's try to solve for the break-even point in terms of the amount. We will going to use the new total fixed cost, which is 630,000 pesos, divided by 42.5%, and that will give us 1,482,353. From our base break-even point in terms of peso amounting to 1,600,000, you will only need to sell in terms of the amount of 1,482,353. So your break-even point in terms of peso or in terms of amount will going to decrease due to the increase in the contribution margin ratio and to the increase in the total fixed costs. Just a recap in this lecture video, what is important here is the relationship between the unit sales price, the unit variable cost, and the unit contribution margin. So if the rate will change, everything will going to change as well. If the per unit will change, that will change the composition as well. That's the end of our lecture video. Thank you all for watching.